All the time, so we should be fine to start. We are recording already. Yeah, cool. Okay. Hi everyone. So today we're gonna be continuing with the series that we've done about econ. So this is the second part where we're gonna be talking about corporations. So if I can get the next slide. So starting with some very general stuff and general advice in terms of common mistakes that people do when it comes to debates that include corporations. So the first thing is that the analysis that you are doing when you're describing corporations, how corporations think and how corporations act, it should be nuanced in the way that often people make the mistake of A, analyzing corporations as if it's an individual actor, and B, analyzing them as if the only thing that corporations care about is profit. So often you hear the analysis of, the corporation is profit incentivized, hence it will do X. The truth, obviously, it's a bit more complex in a way that there is a multiplicity of actors that exist within corporations and often who have different, sometimes even contradictory incentives. So it's often very helpful to analyze it through that. We're going to talk about it later in the workshop more in depth. And similarly, there are a variety of incentives that don't just amount to profit and can sometimes be even contradictory to making profit. So again, this is something to keep in mind when it comes to analyzing corporations. The second thing is to make sure that when you are impacting, you are always linking your impacts to lives of the consumers and you are explaining how those lives are affected to better or to the worse. So sometimes people finish the analysis by saying something like, there's going to be more competition or something of that sort, or corporations are going to be making more profit. A lot of it is unclear why this is a good thing and why I should care about it, meaning that you always should be thinking how this links to the consumers' lives, how can I make it and explain how it affects the people on the ground. So it's the general advice before we go into more technical stuff. If I can get the next slide. So the first thing that we want to talk about is just broadly explain about how companies gather capital. So the first thing then is in terms of different sources of investments that companies have. So the first one, quite straightforward, is just the capital of the owner. So like the, I don't know, the small $1 million loan that you got from your father and then you set up your company. And like that's the initial money that you are able to put in. Obviously, it can be like multiple people setting up a company. So there is the owner capital. Two, there are private investors that can invest into your company. Like, you know, if you watch like Shark's Den or Dragon's Den or whatever that thing is called, right? Like those people who like pick a company that they believe is going to do well and they invest into it and like involve themselves into it, etc. Three, you obviously have profit, so that's a source of money that company is making. Fourthly, it's things like it's debt that you can make through, that you can get through loans or through bonds. So you can get a loan from a bank that helps you set up the company, make it work. Then once you start making money, you can pay it back, or through issuing bonds. Obviously, there are limits to what extent you can do that. So when it comes to bonds, right? If I am it depends how big and how trustworthy and secure your company is, to what extent you are able to sell those bonds and how much interest you have to offer to people. So for example, if Apple issues bonds for some reason, given that can be very sure that Apple is not going to crash tomorrow or in a month or in a year, those are bonds that would probably people would be willing to buy them a lot. Again, if I'm making a startup and I'm making a new company, which is unclear with some new idea that people have no idea if it's going to work or not, those are obviously significantly more risky. So again, there is a limit and like an obstacle for people to be able to raise capital that way. Similar with loans, right? A bank is also not going to give you loans if they believe that you are unable to pay them back. And lastly, stocks. This applies to the, I'm going to make the distinction of public and non-public companies. These are only applied to the ones that are public. And we're going to talk about stocks in length later on. So all of these are sources of investment. I think the way that you can apply this in debates is often to, for example, to analyze things like why there are barriers for individuals to be able to set up companies. Like, when teams are like, but then people are going to be setting up companies, blah, blah, blah. Like, these are ways that you can point out that there are clearly barriers in terms of how people are able to access it. And obviously for other types of analysis when you can need these things. Second thing then, in terms of distinction between public and non-public companies. So some companies use some of these sources of investment more than others. So when it comes to a public company, this is a company that has sold all or a portion of itself to the public via a thing that's called initial public offering, so IPO. Again, we're going to talk about it later. So that's a company that has public shareholders who can buy their stocks and have like a level of control over the company through that. On the opposite side, a non-public company, or like that usually is a private company, is something that is owned by the company founders, management, or has a group of private investors that are not like coming through the stock market, that is significantly more like in the control of the individuals who own it. So that's broadly the distinction. The one thing I would just point out is there is sometimes a misconception that public companies are the big ones, private companies are the small ones. There are reasonably big private companies as well. There are advantages and disadvantages of going public that we're going to talk about later. So obviously many companies do choose to go public, and this is the case for a lot of the big ones. But again, it's not a rule and it's not a must. So this is something to keep in mind, that not all companies have stocks. A lot of them do, but that's the distinction linking to the sources of investment. If I can have next slide. So talking about stocks more in detail. So first thing is, why would people buy stocks? So I think if it wasn't clear from before, you can buy a share, like a percentage of the company, and if the company is making profit, you are going to be getting some level of like dividends money coming from it, and you get some level of control. So this is the percentages is stock. So why would people buy stocks? So the first reason is because of the dividends, or because of the money that you are getting as a result of the company making profit. This is often done by actors like hedge funds, often by individuals who look for a stable investment portfolio. So if I have a lot of money and I want to have some sort of stable income without doing anything, I can invest into multiplicity of stable companies, and I can get like reasonable amounts of money coming from it as a result, providing none of them crashes. The second reason can be control. So as I said, if you have stocks, you have a level of control over what the company is doing. Obviously, you have to have a reasonable amount to be able to exert any control that is useful. So the actors that tend to buy stocks for that reason are actors like other companies who are wealthy enough to be able to buy a lot, or like wealthy people, again, who do have that money. And lastly, in terms of speculations, so those are the quantitative trading firms, or like the Instagram entrepreneurs, who like individual traders who have like their app, and they are trying to buy, to speculate about which of those companies is going to boom and which is not. The question is, so the mechanism then is in terms of that you're going to have a control over the vote, like you are able to vote over the decisions that the company is making. I think in the Q&A later, I think Rhys is more of an expert on boards of directors, can see what the specific link in terms of electing board of directors, etc. would be. But generally, like, for example, things like if the company is able to do restructuring, if the company is able to expand, etc. Like a lot of these things can be influenced by a shareholder, or if the company is going to, I don't know, like who it can be purchased by, etc. I think we're going to talk about that in a bit as well. So if you have a lot of stocks, especially if you have the majority, like you can make quite large decisions in terms of what the company is going to do. So what affects people's decisions to buy the stock? A couple things. I think first of all, it's just the confidence in general economy. So this is something that we talked about last week. So obviously, if I think that the economy is going to go badly and a lot of companies in general are going to be doing badly, performing badly, I am less likely to be starting buying stocks as a result. Also, if I think that I will need savings and money that I don't want to have invested into something because something's going to go badly, again, I'm not going to be investing as much. Two, it's the confidence in the company. So obviously, if I'm someone who actually does look into the specific companies, I probably want to invest into one that I can reasonably assume that is going to go well, as opposed to a company that already has issues, is likely going to fail in a bit. So probably I'm not going to be investing into that. And lastly, and I think this is quite important, and this is the way that a lot of people, especially average individuals, invest, is just not looking into the specific companies and making research about the specific companies, but broadly by following trading trends. So if you have the trading app, like sometimes you can just see what are other people buying. And if you see that a lot of people are buying the same thing, you can assume that it's probably safe, meaning that people are buying it as well. I mean, like you decide that you're going to buy it as well. So this is a thing that is quite useful in terms of analyzing how bubbles happen. So sometimes you have a company that perhaps is not particularly valuable, but for some reason, a lot of people jump onto that bandwagon, start buying a lot of it. Like, for example, when people thought that, like the 2008 crisis, people thinking that mortgages are going to be incredibly safe, a lot of people jumping onto it, turning out they're not. So in a similar way, because of people just following the trading trends without so the GameStop is something a bit different. I'm actually going to talk about it in a sec. So in that way, you can have a bubble, and then when it's exposed to the company or whatever is the asset that people are investing into is not as secure or as good as it's believed, then the bubble bursts and people lose the money that they invested into it. So this is a way that you can, this is the mechanism you can use to analyze it. I hope that was somewhat clear. So the last observation then, and that's where the GameStop comes, is that the value of a stock does not equal the value of a company. So I think I already kind of touched on it with the trading trends, but it's less so what the company is actually like how valuable the company actually is and how much profit it's actually making, or like any of those other things. It's more what the confidence and what the perception of that value is and how many people are willing to invest into it. So again, like companies might be not making profit, but people believe in it, meaning that they're buying it. Like often, like companies like Uber, etc., not making profit, still being invested into quite a lot. So in terms of shorts, so speaking of that, we want to like first to explain what short selling is. So we have a great example on which we're going to explain to you what short selling is. It's about Kardashians again. So basically, the way short selling would work is, for example, say I think that Keeping Up with Kardashians DVDs are going to go really badly. So I think that people are stopping to like it and people will stop buying it, and it's going to decline in prices. I know that Rhys owns a DVD of Keeping Up with Kardashians because, of course, they do, because they love it. So what I'm going to do, I'm going to ask Rhys if I can borrow that DVD of Keeping Up with the Kardashians. I'm going to promise them I'm going to give it back to them in, say, a month when I'm thinking, the price is going to go down. So they're going to give it to me. I'm going to sell it for the price that it has now. And in a month, when, if I'm correct, no one is watching Kardashians anymore, the price is going to go down. I'm going to buy it again. It's going to be cheaper. So I won money out of it. I'm going to give it back to Rhys. So I assumed that Kardashians are going to go down in value. So I did that like little thingy and I made money out of it. So you can assume this, like you can imagine the same mechanism happening with with stocks, right? So if a lot of people or like a lot of the speculators will have a reason to believe that some company, for example, GameStop, is going to go badly, so they just buy, like they short that company. They short those stocks, assuming that those stocks are going to go down in value. So when they buy them back, those stocks are they're going to make money out of it. Obviously, this is risky because there's always a chance it's going to go the opposite way, and it's going to raise in value, and then obviously I'm going to have to pay a lot of money to give it back. But again, if I'm reasonably confident that that it's going to go badly, it's a way that I can make money by betting that the company is going to be unsuccessful. I hope that makes sense. So moving on from if shorts make sense, then what a short squeeze is. So again, if I want to make it on the Kardashians example, so I am being a big speculator. I borrowed the Kardashian DVD, and now I think it's going to go badly in price, and I'm like, ha ha ha, in a month it's going to go bad. Say that you really hate me for some reason, and you want me to lose a lot of money. So for that to happen, you're going to go into the town or go anywhere you want. You're going to buy all the like DVDs of Keeping Up with the Kardashians. So the supply of Kardashians is really low, meaning that, like, supply demand mechanism, the price is going to go up a lot. Meaning that when I'm then going to go, I'm going to try to buy the Kardashian DVD back to give it back to Rhys. The price is going to be much higher than the price I sold it for. So I'm going to lose a lot of money. So again, this is what happened with GameStop in terms of the example, because when people found out about the shorting that happened, they would go and buy a lot of the GameStop stocks, meaning that the price, as you can see on the graph that is there, would go up massively. So the people who try to short it would lose a lot of money. So that's broadly how it works. I hope that made sense and it wasn't confusing. Cool. Okay, everyone's just making jokes. No one looks confused, so fine. Okay, cool. In which case, I can get the next slide. Okay, so the next thing to talk about then is the initial public offering. So I mentioned it before, in case you forgot it. So that's the thing that the company will do at the point where you decide that you're going to go public and you're going to allow people to buy your shares. So there is a couple of reasons why a company would decide to do it, and a couple of reasons why a company would maybe hesitate to do it. So first of all, talking about the advantages. So the first one, which I think is quite straightforward, is like it gives you money because there's obviously many more people who can buy shares than the limited amount of private investors. Meaning that A, you have money, general, that's good, but B, you also have capital in order to expand. So often the reason why companies choose to go and make an IPO is because they want to make some sort of big expansion and they need to raise a capital for it. So you can that expansion can be of your existing business structure. So you just want to make the production bigger or something of that sort. It might be for innovation. You need to temporarily be able to invest into research and development that's obviously not immediately profitable. So you need to have extra capital to be able to do that. Or things like diversification. The example of this is, for example, when this was a big thing in like financial circles, when the Saudi government would put the oil company Aramco of Saudi Arabia into an IPO, which was previously just owned like within Saudi Arabia, now making it public. The reason for this is because they would want a significant amount of money to be able to do diversification. So because Saudi Arabia was so dependent on oil, they would want to have a lot of money that they are now able to invest into other things that they would want to, and they want to diversify to protect themselves from being getting into a risky situation in case like oil prices go down, etc. So that can be another reason as to why you would go, because you want to diversify the things that you are able to produce. The second reason is because you can align material interests with profit. So what often happens when you have shares is that the company gives bonuses in shares. Either they give bonuses in shares for high administrative positions, or they make a minimum shareholding requirement. So what this means is that if I am a CEO of something, I have a requirement to hold certain amount, often a quite big amount of shares. The reason for this is because then if the company is doing well and it's making more money, my shares are also doing better. If I'm going to fuck up as a CEO and the company is going to go down, also my shares are going to go down, presuming that I'm owning a lot of them. I don't want that because I don't want to get poor. So I have my incentive is for the company to do well because I have a personal stake in it. So for example, that was a year ago or how long, the new McDonald's CEO just didn't own any of the shares, but McDonald's did have a quite large minimum shareholding requirement, meaning that like he would have to spend a significant amount of money over time, obviously, to acquire those shares because they would want them to have the sort of alignment of those incentives, because otherwise the CEO like still has an incentive to do well with the company, obviously, but like this is a extra personal stake you can make them have. And then in terms of disadvantages and reasons as to why you would not want to do an IPO. So the first thing is the loss of control. So obviously, I think the first thing that we already mentioned before, your shareholders are going to have voting rights, meaning that, for example, if I want to make some decision that is quite radical, for example, I want to do restructuring, if my shareholders don't agree with this, then I can't. So I'm always dependent on the shareholders to agree with me on big decisions, etc. The I think more extreme scenario, what can happen, that's a risk of an IPO. It doesn't happen that much, but it is a risk, is in terms of hostile takeovers. So what can happen, for example, is that a company that doesn't like my company, or a company that just likes to acquire companies and then sell them again, like, the speculative companies, etc. Someone can buy more than 50% of my shares. Now they acquire the majority of voting rights. And at that point, they can also vote for my company to be acquired by that hostile company. And then they do whatever they want with my company. So this is a way that the IPO can go wrong. Obviously, there are ways to prevent this that companies can do, but it is a risky thing that is something to keep in mind, I guess, in terms of cautiousness. The second reason what the disadvantage is transparency. So obviously it's a good thing, I guess, for consumers sometimes, but sometimes it can be a bad thing for the company. So this can look in things like quarterly reporting requirements. So you have to give a financial statement, you detail the company's balance, income, like the cash flows that you had before over the previous financial quarter. So you have to be transparent in terms of how where your money is going, which is again quite important. Like again, I think if the example of Saudi Arabia, one of the reasons why there was a speculation about whether this is a good thing or bad thing is because if you had some sort of shady business going on in Saudi Arabia, and if the big oil company was put in an IPO, again, you would have quite significant requirements to be transparent. So that's a concern that a company has to think of before they go public. The second thing is in terms of scrutiny, just outside of the reporting. Generally, given that people who invest into you want to make profit, they are going to be checking, they're going to be looking into the company and making predictions based on what you're doing, whether you're going to go well or whether you are going to do badly. So because of that, you also have an extra scrutiny of the people who are investing into you. And similarly, people who want to short, given that shorting is quite risky, right? Because if the company does really well suddenly and I shorted it, like I'm going to lose so much money. Often people before they short, they do significant amount of research and check into how to be very, very clear why the company is going to be is going to be doing badly. So it's an important check that you have on the stock market. So for example, if you've seen the movie The Big Short, it is an example of how people can look into assets that look like bubbles, look really safe, and actually figure out maybe they are not as safe and be able to expose it and be able to short it. So as a result, then you have that extra scrutiny by investors. So I think these are the reasons and the concerns that you would have before going for an IPO. I think this is all in terms of stocks and public companies. I think now we're going to talk about corporate decision-making structures, and I'm going to give it to Rhys.
Yeah, I'm going to assume that everyone can hear me. So in the next part of the workshop, what I want to talk about is how we do the thing we mentioned at the start. That is how we stop analyzing companies and the way they make decisions as just being single actors, and instead inject some nuance into this by talking about the various people that might be making decisions within those companies. The first thing I want to do then is just run through the different positions you might have in the corporate hierarchy. So the different actors within a company that might be responsible to some extent for making their decisions, why they might care about different things, and therefore why you might get different decisions based on whose remit it is to actually make individual decisions about that company's direction. And this list is kind of from the top down. So companies have very kind of vertical structures, and we're going to start with the people with kind of the most power, if you like, and go down to the people with the least. So in some sense, at the top of most companies is what would be called its board of directors. So these are people who aren't involved maybe in the day-to-day running of the company so much, but do make the big decisions about what it is that they will do, i.e. the hiring and firing practices for their chief officers who come below company direction, those kinds of things. These boards of directors are responsible essentially for shareholder profit. That is making sure if you're a public company that your shareholders are making money on their stocks, or otherwise, if you're not a public company, managing company direction so that that company itself makes a profit. They can also vote people from the board, off the board of directors, etc. They have various powers. Below them, although also usually sitting on the board amongst other people, you have a series of chief officers in your company. So for example, you'll have the CEO, the chief executive officer, who's responsible for the overall running of the company, the CTO, the chief technical officer, who's responsible for whatever technological divisions it has, the chief financial officer, or the CFO, who's responsible for that company's finances, and so on. The relative power between these different actors will depend on exactly what it is the company is doing. So obviously, for example, in a tech firm, the CTO might be relatively more important than in a firm that's not working in the tech industry. What do these people care about then? I think, obviously, if you're one of these chief officers, you're going to care about a series of things. The first one, and I think the one that debaters will say a lot, is that they might care about profit. I think there are a couple of reasons that are useful to keep in mind that they care about profit, though. The first is obviously that they don't want to get fired. And to the degree that they're responsible for shareholder profit, because the board of directors is going to fire them if they're doing a bad job and they're not really meeting their roles goals, then they are responsible to that because of the board of directors. Also, though, like we said earlier, often these officers have to hold shares in the company themselves. They have to take their personal money and buy up large amounts of shares in that company just as part of their contract. And these are shares that they can't sell, which means their personal profit incentive often aligns with the profit goals of the shareholder or the company as well. They're also, though, going to care about a bunch of other things. For example, they probably themselves want to have a good working life. They probably also want the company to do well under their leadership because they have some sense that that company and its performance is their legacy and the image other people have of them. And that's something that they're going to care about. Of course, they might also have some perception of the company having maybe risen up through it, and they might care about what they think the company should look like rather than just how it should make profit as part of that legacy. These are all reasons then why chief officers might want certain things within a company. We'll come back in a second to how that interplays with how companies make decisions. Below the chief officers of a company, you're going to have in almost every company various forms of management. So for example, your company might be split into various divisions or departments. For example, you might have like, I don't know, a financial department of your company who deals with the company's finances. You might have a tech team and so on. These departments then are usually also going to be split up into teams, and you'll have structures of management in all of them where there's someone who is the boss of some team And then there's a series of teams who are all managed by one person, moving vertically up towards the people at the top. The various forms of management, I think, have a fairly obvious set of incentives that are useful to keep in mind in debates. Firstly, I think they just care about their pay and their ability, therefore, to make money. They also presumably care about their working conditions, given that these are people who are often now controlled by managers and their managers' desires of them. That often affects their work in life in various ways. They also often care about corporate advancement because they're people who are trying to move up through the company to get to the better and higher paying positions. What this often means in particular is that these are people who want to be able to claim credit for the innovation or the productivity of their teams, and therefore want their teams maybe to do well because it reflects well on them. As a result of this, it might be that there is some interplay for forms of management between A, the incentive to see that their teams are happy because those are people that they work with, and B, contrasting with that, the incentive to see that their team is productive for the company and does well because that's the thing that will personally get them advancement. And I think these two different characterizations are often ways you can push in different directions within debates when talking about how management might make decisions. Finally, below the people in management are obviously the kind of normal everyday employees. There are broad classes of these in different positions. Obviously, I can't go through all of the different jobs you might have in a workshop. That would take far too long. But broadly, these are people, again, who care about their pay, their working conditions, and so on. The final thing I want to highlight when talking about corporate hierarchies is, as well as having different incentives, these people have different amounts of information as well. So, for example, obviously, the average employee of a company who's on the kind of front line of that business has a lot of experience with the day-to-day operation of that company and knows a lot about that. Often, though, these might not be the people making particular decisions. It might be someone who is several layers removed from them, who only get small amounts of feedback in terms of data and so on. And that means that they might make decisions in very different ways than you might expect if you were a normal employee who had a day-to-day experience of how it is that company operates. Cool. So there's a question, can I put explicitly what the roles of the different chief officers is in the chat? So I think there's been a link posted in the chat, but I'll just repeat this again. So I don't want to go into too much detail, but for example, a chief executive officer is usually the person who is responsible for the broad direction of the company. So you can think of this person as the big boss who's responsible for managing the other chief officers as well as the direction of the company. The chief technical officer is the person who is in charge of the technological operations of that company. So for example, if they have any web services that they rely on, etc., this officer is going to be the person who controls and hires and fires in that department. The chief financial officer deals with their financial statements and so on. Cool. Having said that, then, I want to move on now to the next kind of actor that might affect corporate decision-making structures. And this obviously is not someone who's internal to the company, but rather external for a public company, and that is shareholders. So obviously, we've mentioned a couple of times that shareholders have profit incentives, and the desire to make profit for those shareholders means that companies will often make decisions with those shareholders in mind. I just want to come back then to the question that Chris asked earlier, which is how do shareholders actually affect businesses and the decisions that they make? And I want to highlight the things I'm about to say are probably particular to UK law, because the way shareholders affect businesses is that when you make an IPO, people who own your shares gain various rights in terms of their interactions with your company, and those rights are written in usually to national law, and so they'll vary from country to country rather. And in particular, what you're about to hear is my memory of UK law. So a couple of things you get if you're a shareholder. Firstly, every shareholder has the right to be informed of and to attend general meetings of that company. Also, depending on the amount of shares that they own, they're able to vote on certain issues about that company. And I'll talk a little bit more specifically about that in a second. Also, importantly, as well as being able to receive the kind of financial reporting information we talked about earlier, shareholders have a right to take companies to court for various things. So they can make what are called derivative claims. For example, if there is what would be called a breach of trust by that company in terms of the way it operates, i.e. if it operated in a way that very obviously devalued shareholder shares and was very bad for that shareholder, subject to certain conditions that define what exactly it means for the company to do that, they are, at least in the UK, able to take that company to court and try to make some kind of financial claim from them. On voting rights, then, I just want to highlight a couple that I think are useful to keep in mind. So if you own 5% of shares in a company, you can call a general meeting of that company. If you have 10%, you can demand an audit of that company's financial operations. And if you hold 25%, I think this is the important one, you can block what are called special resolutions. So special resolutions are things that are required to make big changes within a company. If you want to change the name of that company, if you want to change the company's stated objectives, if you want to change the company's structure, for example, changing the departments within it or engaging it in a merger where it joins with another company, all of these things would be required to be passed by special resolution. And if you own more than 25% of those shares, you can just unilaterally block the decision to do that. So shareholders have various rights that mean that they can control how it is that companies behave. And often then this is something to keep in mind when thinking about public companies in particular. Finally, in terms of corporate decision-making structures, obviously the consumers have some degree of influence over companies. And obviously, consumers have lots and lots of different concerns, and I can't, again, go through all of these. The important thing to keep in mind is exactly then how these consumers might influence companies in the end. And the usual kind of headline for this is what's called voting with your wallet. So what this means is that you create market niches or demands in the market that companies want to try to cater to in order to make profit. And as a result, they're going to change their product or their business practices in order to do that. There are broadly two ways this happens. One is, for example, occasionally people do boycott companies because they find that that company has done something that they think is particularly immoral, and that damages that company's profit margins. More often, though, this happens in the positive sense, where companies note a shift in the market that they could tap into to make profit and therefore start to make different goods. So to give an example of this, there's been a trend recently to, for example, environmentally friendly products, especially, for example, within the food industry. And as a result of this, traditional meat producers have started to make, alongside their more traditional meat-based ranges, non-meat alternatives that they're also marketing in order to try to tap into that market niche and also to avoid the risk of becoming obsolete if the market shifts further away from them. There is a question in the Zoom chat. Let me just read that. No, so the question is, if you have 25% amongst various individuals, are they capable of blocking special resolutions, or does it need to be concentrated? I believe it needs to be concentrated under an individual because those rights accrue to that individual or to that company if a company owns those shares. This might vary from country to country. So I couldn't say this with confidence, but I don't believe that you can just arbitrarily group people, at least under UK law. I could be very wrong about that, though, so I wouldn't quote me on it. I'd like to move on then now to talk about the next thing, which is companies and lobbying. So once you have analyzed what it is companies might want to do, how is it that they go about doing it? Obviously, they have control over their own operations, but I think a common theme in debates about corporations is that often they also have the ability to influence politics as well. There are broadly two ways this happens. The first one is the one I think that people use in debates a lot. That's direct lobbying. The second one I think is actually the more feasible mechanism, and that's the one I particularly want to highlight. So what is direct lobbying first? This is when companies, or rather, for example, members of their boards of directors, their chief officers, directly engage with politicians to try to get them to make decisions that reflect that company. I think the way debaters often think of this is that just politicians are corrupt, CEOs go and bribe politicians, and therefore politicians do the things that companies want. I think you can give a more nuanced view of this, in which politicians are trying to decide which of a number of issues are most important. And in particular, then, if companies or the heads of companies have lots of access to politicians, they're able to make that politician like them by, for example, engaging them over dinner and so on, and then talk about the importance of certain issues. This is likely to make politicians think that those issues are more important just because they spent more time being told about them and thinking about them than potentially other issues that they haven't heard about. And therefore, they think that these are the issues that they ought to be voting in favor of on behalf of the general public, and therefore they're more likely to make these kinds of decisions. Secondly, though, I think there's also indirect forms of lobbying as well. And this is what I would call lobbying via economic importance. So one of the biggest markers of whether a particular politician or political party is likely to get re-elected is the performance of the economy under them. That is, if the economy has done well, it's often very likely that the incumbent candidate is just going to get re-elected. Because they're able to claim that they were responsible for the economy doing well and all of the prosperity that people got because of that. What that means is that often politicians really care about large companies and what they want, because this is something that might be indicative of how well the economy does, even a lot more so than, for example, whatever economic policy they made. So, for example, Donald Trump likes to claim that pre-COVID, the performance of America's economy was dependent on his tax policy. I actually don't know if that's true. For the American public, they believe it's true because the thing they heard about was his tax policies a lot, and then the economy did well. But there are lots of other things going on in that economy, including the decisions, for example, of large corporations that affect their own performance. And it's unclear which of these decisions is what made the economy do well. In particular, then, if I'm a politician, especially, for example, the head of a party, and I want to be re-elected, it makes sense for me to listen to large companies and what it is that they might want, even if this might be in contradiction with potentially my voter base, because I know the way I best get re-elected is that I make the economy do well. And I know that the way I make the economy do well involves often catering to the largest of corporations. And this is what, for example, gives companies like Google, like Amazon, all of these very large companies, lots of power in terms of lobbying, because politicians know that if these companies fail or do badly, the economy is likely to follow, and they're likely to take the blame for it. And so that's something that they often want to avoid. Hopefully everything on lobbying makes sense. There's an additional comment on special resolutions, which is that you need 75% of shareholder agreement to pass it. This is true in terms of voting rights. I believe the thing I was saying about shareholders, though, is that you can even stop the voting on that special resolution in the first place if you own more than 25% of the shares, because of the presumption that that wouldn't pass because you're going to vote against it. You can't do that if you don't already own 25% of the shares. You could, of course, though, just vote that special resolution down. Let's talk about competition next then. So this is coming back to the other thing we talked about earlier in terms of general advice, where debaters have a habit of just saying there is more competition, and that is good. The first thing I want to ask then is, why is it that actually competition is a good thing? I think the broad reason here is that competition drives companies to try to do things that are good for the consumers. So, for example, if there is competition in terms of providing a particular good to the market, then one of the companies has an incentive to try to take the majority of that market share, to be the one that consumers prefer. And that means that in order to beat out the other company, they want to offer better products or cheaper products to the market. And so this competition drives them to behave better. However, it also applies in things like, I don't know, competition over employees, for example. So if there are low unemployment rates, then firms have to compete to try to get employees, and that means they want to treat their employees better as well. So it's not something that just translates at the level of what people purchase, but also, for example, how we employ people. I think this isn't a very complicated mechanism. I think it's one that debaters understand. The thing I want to highlight, though, is that it is useful to say it because it allows you to access quite concrete impacts in the debate rather than a general impact of competition. There are three things I want to say about competition and why it sometimes doesn't work out so well that I think are especially pertinent to large businesses. The first is about price gouging. So what is price gouging? Price gouging is a practice that large companies are able to engage in when they see a potential competitor who might be offering a better product in the long term than the one that they are offering, and they want to drive that competitor out of the market, or drive the prices of their shares down if they're public so much that they are able to buy a controlling interest in that company to take it over. What they do as a result is they say that in the long term, it would be good for me, so good for me if I could do this, that it's worth me making a loss in the short term, drawing on the amount of money my company already has and just lowering prices. So I'm selling things to consumers more cheaply than I'm producing them. I'm going to take that loss, but that means all of the consumers are going to prefer my product over this other smaller company's product. And as a result, that smaller company is going to go out of business, and then I can raise my prices again. And that means that in the long term, competition here hasn't generated good for the consumer because one company has been able to use the advantage it has in terms of the amount of money, for example, it has in savings in order to drive the other one out of business. So, for example, a common application of this is to say that Amazon might engage in price gouging using the information it gathers on its marketplace platform to target products that it wants to be the person selling, and then using the immense amounts of capital it has to just undercut the other businesses so that they can't even lower their prices because they would just be making a loss and would go out of business because they don't have that money backing them up, and Amazon can just wait them out. The second thing, in terms of why competition isn't always possible, which is similar but doesn't even involve making a loss, is that certain platforms agree to make losses on some products in order to draw people in and make profits on another. So, for example, Amazon actually makes losses on most of its deliveries on the Amazon marketplace. It subsidizes these via another platform, Amazon Web Services, where it sells cloud computing to a bunch of businesses around the world. And the reason it does this is that expanding its marketplace and its other operations gives Amazon a greater degree of market share and means, again, in the long term, they can be more profitable. A second example that is sometimes more tangible is that the shopping firm Costco, so if you've ever been there, these are big warehouses you go in that sell all kinds of different products in bulk, actually make a loss on most of the products at the back of the shop, which are also the reason that people go there. So this is the kind of food products that you would buy for parties that they put all the way at the back. And they make a loss on those because they know you're going to walk past all the other stuff along the way, which they're marking up and they're making big profits on. So even though everyone goes to Costco for the stuff at the back, and they're selling that stuff at a loss, they still make a profit because you walk past all the TVs and the expensive confectionery and I don't know, the lawnmowers and all of this stuff at the front of the shop on which they're making a profit. And people do, at least in a lot of cases, give in and buy those things as well. And so this is a way to cross-subsidize some of their goods in order to get people to come in and buy the profitable ones. Finally, then, in terms of why competition sometimes doesn't work, obviously, monopolization, so the formation of monopolies where one company basically controls the entire market, is another reason why you might not get effective competition. There's a couple of comments here I want to make, though. I think debaters understand what a monopoly is fairly well, but I think you can apply them a little better than debaters sometimes do. The first is that you don't actually have to have a complete monopoly over an industry in order to essentially get the effects in terms of competition. For example, if you're already large enough that most of the small companies aren't meaningfully competing with you, they're not really stealing consumers from you, and you still access the vast majority of the market because people just don't know about that other smaller company, or that other company is geographically localized so other people can't actually get access to it in the majority of places you're selling your good, you might as well have a monopoly, and you are able to make all of the bad decisions that would come for that in terms of raising prices or offering poor service. So, for example, in theory, there are different web providers on the market of, that you would pay for your internet. These people all treat you pretty awfully. If you tell them there's a problem with your internet, they will tell you, okay, we'll come to fix it on this day in this really long time period. And then often they don't even turn up in that time period. They're offering you really poor customer service, but they know that it's a hassle to swap internet providers, that people don't want to do the research and that they aren't going to make the decision to do this. Whilst there might be, in theory, competition, effectively, because consumers aren't switching, there might as well be a monopoly there, and that means they can offer actually quite poor services. Secondly, though, often you might need to break companies up before they form monopolies. And the reason is that it is often the case that once a company is large enough to be a monopoly, they are so crucial to your economy that if you broke them up and risked the failure of that company, you would be risking, for example, an associated recession. So like we said in indirect lobbying earlier, politicians might not want to break up monopolies, not because they're corrupt, but rather they know that breaking up that monopoly might lead to the loss of thousands and thousands of jobs, and associated with that a loss of confidence that leads to recession. And so they become unable to make that decision, meaning it might be the case that actually you need to predict when monopolies are going to happen and try to preemptively regulate that. And this is why, for example, we have things like antitrust laws that mean that often companies, if they're very large in a particular market, can't even make tiny purchases that would put them over a certain percentage share of that market, even if that percentage wouldn't give them a monopoly, because we want to preemptively regulate before it becomes too late. Are there any questions about this slide? If not, we're going to move on to what I believe is the last slide, which is about research, development, and expansion. So I'll pause for a second in case there were any questions, and otherwise we'll talk about these last two things. Okay, it doesn't look like anything's popping up in the chat. If something pops up while I'm talking, I'll answer it in the Q&A at the end. Otherwise, I want to talk about research, development, and expansion. So these are three things that translate to consumer good at the level of either giving them better products to be able to buy that make them happier in their day-to-day life, or via expansion, making more jobs for people because that company now has more operations and therefore giving more people access to, for example, disposable income. I want to talk about a couple of things that often come up in debates about these themes. The first is about patents. So I think most people know what a patent is. This just says that once I develop a technology and I register the patent for it, only I have the right to use that particular technology, for example, unless I agree that someone else can use it first. So you can't use that technology without my permission within the period that that patent extends for, which depends on the particular kind of technology you're developing, but is usually a decent chunk of time. Often, patents are necessary to have the incentive to develop new technologies. The reason being that often research and development is expensive. And if I know that the second I make that product, anyone else can just come in and sell it as well, because there's nothing stopping them from just stealing the technology from me and they're just going to undercut me, then I'm not getting any benefit from having paid all that money in research and development. And that means that patents are often necessary in order to incentivize companies to actually develop new technologies. However, there is a risk that patents can also make certain goods inaccessible, both by giving companies monopolies over certain markets. For example, in medicine, if I have patents for certain medicines, I'm able to up the prices for them, but also because sometimes you have patents not for a product as a whole, but rather for an individual piece of technology within that patent. And that individual piece of technology, for example, that microchip or whatever, could have been useful in a bunch of other stuff as well, but now other companies can't access it. And so a common theme you might see in debates, and one of the ways that you might argue that large companies buying up startups is good, is that it allows them to pool patents so that they can combine them in lots of different ways, rather than just having them all locked into individual companies who then can't combine them in order to make new products. Finally, on research, development, and expansion, I want to talk about the more significant thing, which is about risk. Obviously, research, development, and expansion all involve upfront putting in lots of money. If I want to make new products, it's going to cost me a lot in terms of that research. If I want to expand, I'm going to have to pay upfront for the operations in the area I want to expand into. Maybe I need to build new factories, I need to hire new employees, and so on. And I'm only going to see the payoff for these things further down the road. It might be, though, that, for example, my research and development in a particular area doesn't make me a great product. Google spent loads and loads of money developing Google glasses, which were like smart glasses we could all wear. And there was hype about them for years. You probably noticed none of us are wearing these products, and Google has made no profit from developing it. They end up losing a lot of money, and therefore, at this point, failed in terms of risk. Equally, if I want to expand into a new industry, it might be that there are unforeseen circumstances that mean actually that expansion isn't profitable for me. Maybe people in that area don't want to buy the product I'm selling, and it ends up, again, that this is a failed business venture, and therefore all of the money I put up front was wasted. I think there are a couple of factors that are useful to keep in mind then, that for debates that affect this. The first is that what's often important in deciding whether a company takes on risk is their perceived confidence, i.e., how big they think that risk actually is. And one of the factors that affects this is that the policy making that politicians engage in. So, for example, if I'm in a country with really unstable financial policy, where the people in charge of deciding what the regulations on businesses are change their mind every couple of months, then the risk of any new project or even of my existing business is much larger, because I could suddenly find my business, due to new regulation, being really unprofitable. And what that means is I might need to have lots of capital kept back in order to be able to eat that blip caused by new regulation that comes in. And so I'm less able to spend that capital on expanding my business. However, stable policy means I'm better able to predict what future risks might come to me, and therefore better know that I can spend lots of my money on trying to expand rather than having to keep it in the bank for a rainy day. Secondly, though, in terms of being able to eat risk, if you have large amounts of capital, it can often be very good for you to take on high risk but high reward projects. So, for example, Amazon or Google can do lots of research and development or lots of expansion, even for projects that are likely to fail because they have lots of money. And when one of their projects succeeds, they make huge, huge amounts of profit off it that makes it worth all of the losses that they took. So, for example, Google might have failed on Google Glasses, but they've succeeded on so many other products that made them huge amounts of profit that was worthwhile for them. A smaller company can't do this because the risk for them is larger. If a smaller company wanted to spend all of their money making Google Glasses and that failed, then they would go out of business. And therefore, that's a risk that they can't take on. Finally, then in terms of risk, and I think the potentially more technical thing in this workshop, so I want to explain this a little more slowly, there are other options that companies have in order to try to hedge against risks. In particular, there are things called derivatives. So that's a kind of fancy technical term that one can use to try to hedge against risk in asset prices. I'm not going to explain derivative markets as a whole because these get quite complicated and the whole of derivative markets don't really see applications in debates. I just want to explain one useful one that is occasionally very, very useful in debating. And this is something that's called a European call option. So a European call option is a contract I write over a particular asset, so a thing I might want to buy. So if Lucie were giving this example, I might say keeping up with the Kardashians DVDs. In reality, I might say something like oil prices. And what that contract does when I write it with someone is it provides me the right to buy that asset. So oil, for example, a barrel of oil at some fixed future date and for a fixed price. It doesn't, however, obligate me to buy that asset. So what I could do, if say I have a European call option and it expires in a week's time and it's for a barrel of oil, is in a week's time, if the price of oil is much lower than the price I've written on this contract, I could just rip the contract up and I don't have to exercise it. And so I can just buy that oil from the market much more cheaply. However, if the price of oil has gone really, really high and I wanted that barrel of oil, then I can exercise my option, a European call option, and use the contract to buy the oil at the prearranged price in order to not have to make all of that loss on the really expensive oil. So if, for example, I'm a business that really needs barrels of oil at certain points in the year in order to, for example, I don't know, use in my factories to produce goods, but I know that the oil market is really volatile and I'm really worried that oil prices might skyrocket at the point where I need it and I'm going to make a much larger amount of loss on that, then it might be the case that I'd rather have a lot more stability. And therefore, what I might do is go to someone with lots of oil and write with them a European call option to make sure I have the right to buy, if I want to, that oil at a fixed price at the date that I'm going to need it. Of course, no one's going to give me this for free because they're not getting anything out of it. And so usually when you buy a European call option, you have to pay someone a certain amount for the right of having that contract with them. And so what businesses are doing when they write these options is in theory paying a little bit more, but in return, they're able to massively hedge the risk that they would be engaging in if, for example, the thing that they wanted to buy in future got a lot more expensive. And this is actually the original reason why this particular financial derivative comes into existence. So that one's a little technical. Hopefully, though, it's something that you understand. And I think in particular, this is useful when you're in debates where people want to talk about risk for businesses and why it is that means businesses might not engage in certain actions that you want them to take. If it's one of these cases where that risk comes from asset prices, European call options are often an incredibly useful thing to be able to explain to the judges to say why businesses might do the things that you want them to do by explaining why the risk is less than what that other team is trying to say is the case. That's everything we wanted to talk about in terms of the slides. As usual, before we move on to the practice debate after this, we're going to have a Q&A. In particular, I think there was one question already earlier that I promised to come back to. So let me find that. And if you have other questions, please feel free now to just type them in the Zoom chat while I'm answering this one. So we did have a question earlier, and that's about numbers of shares, which is the question, will a company eventually run out of shares to sell? The answer in theory is no, because a company can always, assuming it gets, of course, the shareholders who currently have voting rights to vote in approval of this, expand the number of shares it has on the market. The effect of this is that the shares that already exist in the market are going to become less valuable because now there are more of them. This is really similar to the stuff we talked about last week, where governments might expand the monetary supply and therefore money is worth less. You expand the supply of shares and therefore shares are worth less. So in theory, you can always just create more shares and sell them. Those shares, though, are then going to be worth less. And what that means is if you wanted to raise capital in future, it's going to be harder for you to do so because people don't trust the value of your shares because you just keep making more and more of them. And so actually something companies often want to do is manage the value of their shares to a reasonable level. One way that they might do that outside, that they sometimes do that outside of just managing, for example, how good people think the business is engaging in something called a share buyback, where they go to the market and they actually themselves buy up a bunch of shares in order to reduce the supply. And so actually, it's not the case that the number of shares that a company has in existence are static. They often go up and down and can be managed by the company to try to manage the value of those shares. There are a couple more questions coming in. So one is, are the derivatives used mostly on resources that you're going to need for your business over a long time, or is it done commonly everywhere else? So derivative markets are very complicated. There are lots more kinds of derivatives than just the one that I've talked about. The application of European call options in debates is usually for things that you're going to need a long time in the future, and there could be volatility in the prices for it. But that's not really the majority of the derivative market in reality at all. For example, hedge funds write very complicated portfolios of derivatives in order to minimize the risk they take on from various investments that they might make by knowing that they can always buy back shares at certain prices or sell them at certain prices and so on. I don't think that sees particular application in debates, so I don't want to spend a long time talking about that, even if I think mathematically it's very interesting. There are more questions coming in. Yeah, so there's another one. Shareholders always share a percentage of investment. How is the share of the stock market arranged? So yeah, a share or a stock is literally a percentage ownership of the company. That's what's being sold to you when you buy a stock. And so a shareholder who owns shares will always own a percentage share that lines up with the number of shares that they have bought. And the way that this works is that the company offers shares on the stock market, and then via various middlemen, you can, in an initial public offering, buy those shares from the company. And then later on, there is a market where people buy and sell shares through middlemen from each other rather than just from the company. There are more questions coming in. So this one about short selling. Can't short selling lead to self-fulfilling prophecies where everyone dumps their shares at the same time and cash flow and confidence in the company dries up, making it fail? So shouldn't we ban shorting? So to some extent, yes, it can lead to that because there is a trend of people following the actions of large investors within the stock market. So if you see one person shorting, you might suspect that there is a reason they are shorting and want to jump on board and want to sell shares. But that doesn't mean that short selling isn't overall useful. So there are lots of reasons why short selling might be useful, both in terms of, for example, allowing accurate pricing within the market, because often large numbers of shares within companies might be held by certain people who don't want to sell. But it might be the case that it would be useful to have people selling those shares in order to accurately reflect the effects of scrutiny and so on. And that means short selling is a useful mechanism in order to try to make people do this. The second and more complicated reason is that in order to hedge risk, sometimes investors want to be able to put together certain portfolios where they have lots of different shares and that they buy and sell in combination. And sometimes that means you need to sell shares that you don't have. This probably wouldn't come up in a debate, I don't think, but is a good reason why short selling is actually useful in financial markets. There's a second question under this. Is cartelization, i.e. collusion between competing companies, a thing? Is it common explicitly or implicitly? And do companies have an incentive to do it as opposed to compete or monopolize? Yeah, so absolutely, this is a thing that does happen. And I think, for example, the example I gave about internet providers is probably actually an example of this, because in theory, any internet provider could start being really great and advertising really heavily, and maybe we would all decide to switch to them. But no individual one has an incentive to do this because it would be costly up front to try to get everyone to switch. And that often means that it's one of the ways that you can get effective monopolies that we were talking about, even if you don't have an actual monopoly. Cool. Hopefully that answers all of the questions we've had so far. There's another question about shorting. When shorting, who do the companies borrow the shares from? I.e., who is Rhys in the real world? So the answer to the second question is I'm Rhys in the real world, but I'm not lending everyone shares. So the answer to this is it's similar to what happens with fractional banking. So there are people who, like when I buy a share, it might be that I don't actually have that share. It's not like I physically keep like the certificate somewhere. Rather, someone else holds it on my behalf in an account. And as a result, they just have it sat there. In fact, though, they're doing this for loads and loads of people, right? And that means that they can be confident that it's probably not going to be the case, that everyone who owns a particular share is going to sell it at one point. And what that means is they're willing to do the same thing banks do with fractional banking. They're willing to take some particular shares and lend them out to some people who want to short sell and say, okay, you have to give this back to me at a certain date, and you're going to give me a little bit of money for doing that. And as a result, there are all these middlemen who are making profit by enabling short selling within the market. Yeah, I don't actually own any Keeping Up with the Kardashians DVDs. This is all a lie. But thanks, Lucie. Are there any other questions about anything we talked about in the workshop? Okay, there's lots of speculation about my involvement in ownership of access to Keeping Up with the Kardashians, but it doesn't seem like there's any more questions. So I suppose that means we're ready to move on to the practice debate.